Hi, Anthony Terrell. Welcome. Thank you for meeting with me again. Today we'll be going through TERS 401k contribution, and Anthony will be talking about a little bit about profit sharing plan, retirement plans, and how to transfer ownership of the animal care center to your employees. Now let's get into it. So, TERS, your maximum 401k contribution, according to IRS, the maximum annual contribution is $19,500. However, you qualify for a catch-up contribution of $6,500, which make a max annual contribution of $26,000. Now, how much? What's the tax saving um, you're gonna have if you make this contribution? So the federal income tax savings are calculated this way. The max annual contribution I said in the slide before is $26,000. Your tax bracket is 35% federal, so the total amount will come out as $9,100. Basically, by contributing $26,000 to your 401k, you'll be saving $9,100 in tax. Now how much will your employer contribute to your 401k? So your max contribution is $26,000, and according to the case, your employer matches 25 cents per dollar. So the the match will be on over $26,000 is $6,500. However, your employer can only contribute up to 6% of your salary. Your salary is $50,000, so the maximum employer contribution is $3,000. Your total 401k contribution would be $29,000. Now, Anthony, let's talk about you. You said that you want to start taking um, distributions from a profit sharing plan to start saving for retirement, right? I believe that a very beneficial way to do this is through net unrealized appreciation, also called NUA. NUA is a treatment for lump sum distribution of employer securities. It's mainly tax advantage vehicle, and I say this because the only thing that will be taxed as ordinary taxable income is the basis at the time of contribution. NUA, which is the fair market value minus the basis, will be taxed as capital gain, long-term capital gain, sorry, only when a participant, so you, Anthony, or a beneficiary sells the stock. Now, the basis in your case is $15,000. That would be the only thing taxed as ordinary income, so 35%. The NUA will be taxed as capital gain when the stock is sold. Now, let me show you in this tab, in this um in this table, it shows the long-term capital gain tax rates for the 2020 tax year. You and Terra are married filing jointly, so you'll be paying 0%. You'll be taxed on a 0% rate if the NUA is up to $80,000. Now, if NUA is in between $80,001 and $496,600, you'll be taxed on a 50% rate. The highest rate you can go is 20% rate, and it only happen if the NUA is over $496,600. Moving forward, you're wondering if the Animal Care Center makes a profit sharing contribution of $195,000 to your employees. How much each employee will receive? Okay, so we know that at the Animal Care Center there are two vets, you, Anthony, which are the owner, two vets, and 23 other employees. For a total, so basically, you, Anthony, and 25 employees. Now, in this table, you can see each salary, the percentage, and the contribution received. Let me explain it to you. So, Anthony, you have a salary of $250,000. Eric, your nephew, and the other vet have a salary of $85,000. The other employees, as you told me, the average salary is $32,000. Now the total salaries will be $1,156,000. Um, the percentage of that they will receive, the percentage contribution can be calculated just by doing the employee salary divided the total salaries. So Anthony, you will be receiving your contribution percentage is 21% and 21.62%. Eric and the other vet, the percentage is 7.35%, 7.35, and the rest of the employees is 2.77. Now, to calculate the contribution received, you grab the contribution of $195,000 and you multiply by the percentage. Anthony, you're receiving $42,159. Eric and the other vet will be receiving $14,333, and the rest of the employees will be receiving each $5,402. Lastly, Anthony, this is a little bit complicated, but it's gonna be very helpful for you. You've been asking me how can you transfer ownership to your employees, because this is part of your financial goals. So a way to do this is leverage SOP. SOP stands for Employee Stock Ownership Plan. Basically, the Animal Care Center will be establishing an SOP trust for the benefit of employees. How this happen? A bank will be making a loan to the Animal Care Center, which then will lend those funds to the SOP trust. That way, they will help to purchase the stock, which will help the trust purchase the stock from you, Anthony. Now, the stock, sorry, the stock bought from Anthony, from you, will be held in a suspense account. Also, the Animal Care Center will be making contribution to the trust, which in turn uses the contribution to repay its loan from the company. The share will be released from the suspense account, and they will be allocated to individual employees' account. Basically, also this will make the employee become vested, usually over 6 years, and the employee will receive distributions when they retire or leave the Animal Care Center. The principal advantages of a SOP trust, of a leverage SOP, are mainly tax advantages. In fact, an advantage of the SOP is ability to use tax-deductible company earnings to fund the SOP's purchase of the stock. Also, Anthony, you can sell some or all, depending on you, of your stock while postponing indefinitely the capital gains tax on the sale proceeds. Moreover, Anthony, you can retain full operational control of the company while at the same time cashing out some of your equity that is tied up in the company. Lastly, as I said, the employees will become vested, which is a great retirement plan for your employees. Now, I really hope I was helpful, and to you, Tara, as well. Let me know if you have any questions. I'll be always available. I'm really looking forward for the next meeting. Till then, be safe and have a great day.